You may recall in our previous discussion, we used the trial balance, the adjusted trial balance specifically, to prepare an income statement and balance sheet. Now, we have to introduce this concept of temporary accounts. Take a look at the income statement. This is what we did in the previous discussion. We took these revenue and expense accounts, we placed them on the income statement, we reported the net income for the period. Revenue and expense accounts are temporary accounts. They're not the only temporary accounts. Dividends is another one that comes to mind, but they're the most common temporary accounts. And think about it this way. Think about when a football team wins a football game. Grand Valley State Lakers, they win their football game. The scoreboard has whatever score is on there. That scoreboard is going to have to be reset to 0-0 before the next home football game so that we can measure the new football game. The same is true for these temporary accounts on the income statement. Sales revenue, these various expenses, those are all going to need to be reset to 0 so that we can start to measure the month of March. Okay? These all relate just for the period of February. We just need those to be 0 so we can start to measure March. Okay? And as you know, we did use this trial balance to prepare the balance sheet as well. There's the assets, here's the liabilities and stockholders' equity. And the reason I put this in here is we do have retained earnings. Okay? In a previous discussion, I showed you how to calculate retained earnings. Well, what needs to happen is we're going to need to have a closing entry, or in this case, I'm going to do it with 2 closing entries, to take these revenue accounts and these expense accounts, convert them to 0, and make the ending retained earnings balance be $800. And then we're ready to start the month of March. So let's take a look at this here. Closing entries. We start out with the revenues and the expenses here. So we've got our revenues over here, we've got our expenses down here, and we really need those to become 0 as we try to measure the next period. This is what those revenue accounts would look like in the form of T accounts, right? Here's our $6,600 of beverage sales right there, credit balance, $8,000 of food sales right there. So what do we have to do to close these out? Well, we're going to have to make, well, think about it this way. I want you to think to yourself for a second. If you wanted this food sales revenue account to become 0, what would you have to do to that account? And the answer is you would need to make an $8,000 debit entry. What that's going to do is it balances the account out to 0. The balance used to be credit balance of $8,000. If you make a debit to that account, it's going to wipe out the account's balance. Same is true here. So to get rid of $6,600 of beverage sales, we're going to make a $6,600 debit entry to that account. Now, if you're doing the math with me, we've got $6,600 here. We've got $8,000 right here. That's $14,600. And that should be a familiar number. Let me just click back to the income statement here. Notice how our revenue was $14,600. Okay? So what we're doing is we're going to take that $14,600 and we're going to credit retained earnings. Right? So if you think about this journal entry, what's happening here is we're using the 2 debit entries to 0 out or wipe clean the revenue accounts. And then the economic effect of that is to increase retained earnings. Think about it this way. We know that an owner's equity account increases with a credit balance. And that's what's happening. As customers purchase things from us, as we earn revenues from them, we are essentially increasing owner's equity. Now, at the time, we put it in these revenue accounts with credit entries. But then at the end of the period, we debit those accounts and move the economic impact into retained earnings. Because customers have purchased things from us, because we have generated sales revenue from customers, the owner's equity, the owner's worth, if you will, their equity in the company is bigger. Now we have to look at the flip side of that, which is expenses, and expenses definitely reduce owner's equity. After that one journal entry that closes the sales revenue to retained earnings, what you can see is that beverage sales and food sales used to be $6,600 and $8,000. Now they're 0 over here. Retained earnings used to be 0. Now retained earnings is bigger, okay, because of the revenues. What we're going to see in just a moment then, we're going to have to close out all of these expense accounts. And when we do that, converting these to 0 is going to reduce this retained earnings balance. It's not going to be $14,600. And in fact, you've already seen the balance sheet. You know this retained earnings balance is going to drop to $800. But let's prove it. Let's prove that $800 balance in retained earnings that we know really needs to be reported on the balance sheet. Well, what we have is we have all these expense accounts. We have not closed them yet. These dollars represent what happened for February. We need to clear it out and start to measure March. The total of all these expenses is $13,800. And what you're going to see here is that we need each one of these expense accounts to become 0. So take cost of goods sold just as one example. It has a debit entry, a debit balance, I should say, of $350. If you want that account to become 0, you need to offset it with an equal credit amount. And the same is going to be true. We just go right on down the line. So salaries and wages currently has a $9,000 balance. Making a credit entry of $9,000 to that account will reset the balance to 0. Rent expense, $2,400. Make a credit, $2,400 makes that 0. Advertising expense, let's see, that was $500 debit. Credit that account by $500, it'll become 0. You start to get the sense of what's happening here. Utilities expense, debit balance of $600. A credit of $600 will wipe that out. The depreciation expense was $650, so we need to wipe that out with a credit entry. Interest expense, that was $100. This will get rid of that $100. Notice it's not getting rid of it for February. It's getting rid of that so that we can start to measure March. And the same is true for the income tax expense. So each of these expenses, these credit entries that I just made right here, they total up to $13,800. So your journal entry is going to credit each one of these individual expense accounts and is going to make a single debit entry to retained earnings. Okay, it's a little bit over there, but I think you get the sense that that will net out to $800 here. Okay, that's a debit entry on the left-hand side there. What we're seeing is ultimately this. Now I want you to keep this in mind. Remember our little cheat sheet. Assets, liabilities, owner's equity, revenues, expenses. Okay? And by now, I'm sure you have this committed to memory. But I want to point one thing out. Notice how owner's equity goes down with a debit. Okay? That's what we see right here. And expenses go up with a debit. That relationship is such that when we eventually get rid of those expenses, when we close them out, to clean that account to 0, look what's happening. To clean out these expense accounts, to reset them to 0, we need to make a credit entry to that expense account. And when we do that, it ultimately becomes a debit entry to retained earnings, which is owner's equity. So what you're seeing is, when the expense is recorded, we're not directly reducing retained earnings. It's not like you would credit cash, debit retained earnings. We need to measure those expenses on the income statement. That's why we debit the individual expense accounts as we record the transactions. But ultimately, we know what's going to happen is once we've used those expense accounts to measure the expenses on the income statement, we're going to clear them out with a credit entry, and the corresponding debit is going to reduce retained earnings, which is part of owner's equity, or in this case, stockholder's equity. The expense account is simply a placeholder until we get to retained earnings. Now we've closed out the month of February, and we have a clean slate that we can use to start to measure March. And we see that right here. This is the adjusted trial balance that we used to prepare the balance sheet at the end of February and the income statement for the month of February. After the closing entries, what you'll notice is all of these temporary accounts that appear on the income statement have been converted to 0 balances. And the results which is net income, because revenues minus expenses equals net income. So the net income for the period has been closed out and dumped into retained earnings. And that makes sense because the company is just a little more valuable now. We've sold things to our customers. Our expenses were lower than our sales revenue, so we generated a profit. And so the equity of the owners of the company is bigger. It's a more profitable company. It's a slightly more valuable company because we ran it at a profit. Now, what we hope is that we have subsequent months and years where we generate nice profits. And what will happen is every month that we have more net income, this retained earnings will grow with each month's iterative next net income as we generate profits. The only thing that's going to make that smaller would be dividends or distributions. Well, I shouldn't say the only thing. It is possible if we have some losses in the future that could reduce retained earnings. But let's stay optimistic. Let's just hope that we generate those profits, the retained earnings grows, and eventually maybe we can make it a little smaller when we make some distribution payments to the owners.